My name's James Idle. I'm a vice president on the team, and I'm originally from Maryland, attending University of Maryland, majoring in finance. So what does it actually mean to invest? A lot of times the jargon around investing can be intimidating, but at its core, it's quite simple. Investing is when you use money to purchase an asset, whether it's a stock, a bond, or real estate, and hold that asset out to generate more money over time, or what we call a return. When you invest, you're attempting to make money from future events. So no one can actually know what's going to occur in the future, and therefore no investment is truly ever protected from loss. The key is to do enough homework to understand all of the risks and the potential for return, and give yourself a margin of safety such that not everything in the future needs to go perfect for your investment to do well. Today, what we're going to be talking about as an example is Nike. I think a company we're all probably pretty familiar with. It's a very large company. It is traded on the New York Stock Exchange, so nearly anyone can invest in it. They make shoes and apparel and sell them for a profit. And so John's going to walk you through some investing examples using Nike.
Hi, my name is John Rhoden, and I've been in real estate investing for over 4 years after I completed grad school at Texas A&M University in Texas, where I am originally from. One of the most common and accessible ways to invest your money is through the purchase of stock, a term that many of you have heard of and some of you may already be familiar with. So what is a stock and why would you buy them? A stock is a financial instrument that represents a piece of ownership in a company, and you would buy shares of companies that you think are well positioned to turn your invested principal into more money in the future than it is today. And stocks do that in two ways. One, through appreciation, and two, through dividends. Appreciation is by selling your stock for more money in the future than what you bought it for. And dividends are distributions of profits made by companies to their shareholders, their owners, of which you would be one of. Man, that sounds pretty cool. You can be a part owner in some of the world's biggest companies with an opportunity to participate in their successes. You could own a piece of Nike or Google or Facebook even. So the next question is, where would you go to do that? Well, you'd go to the New York Stock Exchange, which is the largest and most active stock market in the world. Think of it like going to the mall during the holidays, except it's filled with millions of virtual buyers and sellers looking to trade their stocks. And it's physically based in New York on Wall Street. So now this sounds pretty special. And you can get there just by opening an online brokerage account, which some of the most popular accounts are through groups like Fidelity, TD Ameritrade, or Robinhood, which all have apps that allow you to manage your account just on your phone. So now you know what stocks are, why you buy them, and where you can go to buy them. But how do you think through which stocks to buy and how to make money on them? First, it really depends on one, how much risk you are comfortable taking, and two, what your financial goals are. For example, younger people like you and me are usually more comfortable taking on additional risk to invest in deals while we are young because we have longer lives ahead of us to make up for any losses that we may experience. However, as we get older, we may want to make sure that the money that we have earned and invested during our lifetime stays level or increases, but we definitely do not want it to decrease. So if you are young, you may buy companies like Uber or Tesla that are first movers in their space and very innovative with chances for high outsized returns, but also additional chance of failure. And if you are older, you might choose staple companies like Walmart or Procter & Gamble, companies that have been around for a very long time and are still successful today. So now it depends on what your goals are, and these could totally range. Most common goals would include saving for retirement through your 401k account, or saving for a large future purchase like a house, or creating additional income streams or income replacements, and finally, just for general wealth creation for yourself and for your family. I hope this helps you better understand what stocks are, why you buy them, where you go to buy them, and what to consider when choosing which stocks to buy.
So besides stocks, bonds are one of the other largest investment products that investors rely on to generate returns. In short, a bond is just a loan. An investor who purchases a bond is simply making a loan to that company who has issued the bond in exchange for the company's promise to repay the investor's principal and interest over time. Typically, bonds range from 3 to 10-year periods with interest payments made along the way, typically monthly or quarterly. So there's two very important differences between bonds and stocks that I think are worth highlighting. First, unlike a stockholder, the bondholder doesn't own any of the company and therefore cannot receive appreciation returns like a stockholder can if the company's value increases. So if you would have purchased a bond of Facebook before it was big, you would have not made a very large return like you would have if you bought Facebook stock. You would have just received the principal and interest as promised. Second, although the bondholder doesn't own a piece of the company and may miss out if the company's value increases greatly, the company has promised to repay the bondholder their principal and interest, which is the bondholder's entire return. And this is a promise that the stockholders don't receive. And in the event the company does go bankrupt, the bondholders get repaid before the stockholders are paid anything from the company. So these features typically make investing in bonds safer or less risky than stocks. So in sum, bonds are safer than stocks because the company must legally repay them. And therefore bonds have less risk. And as we discussed, less risk typically means less return. And so historically, that is how things have shook out. Bonds historically, on average, have provided a 5 to 6% annual return to investors, whereas stocks have provided, on average, an annual return to investors of 9 to 10%. So now that we've touched on both stocks and bonds, one final concept to understand is a mutual fund. A mutual fund is simply a company that an investor can buy shares in, just like Nike. But what this company does is owns other stocks and bonds and passes along the returns to you after taking a fee. The primary benefit of a mutual fund is what's called diversification. Diversification is simply the idea that by owning a number of different investments that make money in very different ways might present you with less risk of loss if any one of those investments goes under. And on the other hand, may also present you with a better chance of gain if one of those companies becomes the next Amazon, for instance. So you might ask, well, why wouldn't I just choose a number of stocks and bonds myself instead of paying a mutual fund a management fee to do this for me? And the answer is twofold. First, because you may not know how to achieve diversification yourself if you're not doing this as a day job. You may inadvertently think that two stocks are diversified when they're not. For instance, Boeing makes airplanes and Hilton owns hotels, so you may think they would perform differently, but they both generate money when people travel. And so their individual returns may actually be quite similar depending on whether people decide to vacation one year. And second, because individual share prices can be quite high. Amazon's share prices, for instance, are trading at above $2,000 a share, and therefore you may not practically be able to invest in certain companies if you only have a few $1,000s to invest. Whereas mutual fund shares are much lower in price, between $10 and $50, for instance. Mutual funds are an extremely important tool for most people with savings that they want to invest, and I would say are far more used by most investors than purchasing individual stocks and bonds. So one final note on mutual funds is that it allows you to build a number of investments in both stocks and bonds by doing what we call building a portfolio. You can build a portfolio by purchasing a stock fund and a bond fund separately, or by purchasing shares of a mutual fund that has both stocks and bonds within that individual fund. The reason that many investors do this is because it allows your principal to get the benefits of both stocks and bonds together. So your principal has the potential to receive some of the higher appreciation and higher returns that stocks provide, while also getting the benefit of some of the safer features that bonds provide. Ultimately, your principal would then therefore get a return profile that's in between if you would just purchase stocks or bonds alone. This concept of building a portfolio is extremely important and one of the ways that I would say most people invest across the country.